Your bank probably sold you on a home equity line of credit, a HELOC, as a cheap, flexible way to get at your cash trapped in your house. They told you it was a smart move. They said it was safe, backed by your single biggest asset. But here's what they might not have told you. It's a financial time bomb. Right now, after a few rocky years for the interest rates and the housing market, thousands of Canadian homeowners are in a risky spot. That HELOC debt has surged to its highest level in years, climbing to roughly $179.5 billion. That's a massive amount of debt tied to an asset whose value is no longer guaranteed to go up. In this video, we are exposing the 3 hidden triggers that could cause your HELOC to financially explode. And I will tell you exactly what you need to do right now to defuse it before it's too late. Let's be honest about what a HELOC actually is. Forget the fancy marketing. A HELOC is a giant credit card that uses your family's home as a collateral. It's tempting because for a while the money felt like it was free. But that era is over. The first trigger and the most immediate danger is the variable interest rate. Unlike a fixed rate mortgage where your payment is predictable, most HELOCs have variable rates tied directly to the Bank of Canada's policy rate. For years, this wasn't a big deal. But as rates were hiked up aggressively to fight inflation, those low monthly payments shot up. Think about it. It's clear that for many Canadians, what was once a manageable interest rate only payment has jumped dramatically. A payment of $500 a month a couple years ago could easily be $800 or $900 today. And that's without paying down a single dollar of the principal you borrowed. For many families, that extra few $100s a month is the difference between stability and panic. This is the variable rate trap. The bank qualified you based on the interest rate at that time, with little thought to whether you could handle that payment if the rates went up. And many people drawn in by the allure of interest-only payment just kept servicing the debt without even making a dent in the balance. You are running on a treadmill. You are making payments, but your debt isn't shrinking. All it takes is for that treadmill to stay at that high speed for too long, and you are going to get thrown right off. This brings me to the second and arguably most dangerous, the vanishing equity illusion. Your bank was thrilled to give you a massive HELOC 5 years ago. Why? Because the housing market was on fire. They appraised your home at the peak value, maybe 20 to 30% higher than it was, and generously offered you a credit line for up to 65% of that new inflated number. On paper, you felt rich, but that paper wealth can disappear as fast as it appeared. While national home sales are down, the market is fragile. Forecasts show that the prices in some regions like Ontario and BC will likely remain well below their past peaks, and for some areas even seeing continued price weakness. So here's a nightmare scenario. Imagine your home was valued at $1 million at the peak. Now you have a $600,000 mortgage and the bank gave you a $200,000 HELOC, which you have maxed out on renovations or paying off other debt. Now your home value drops by 15% to $850,000. Suddenly you still have that $600,000 mortgage and you still owe the full $200,000 on your HELOC. Your total debt is $800,000 against a home that's only worth $850,000. Your real equity has shrunk from $200,000 down to just $50,000. But what if the prices go down further? What if the home value drops to $790,000? You are now officially underwater. You owe more on your house than it's worth. You can't sell it without bringing cash to the table, and you likely can't refinance it. You are trapped. This is where the ticking bomb can really feel personal. The third hidden trigger is buried in the fine print of your HELOC agreement. The bank holds all the power, and they can choose to pull the plug at the worst possible moment. These agreements contain clauses that give the bank the right to freeze your line of credit, reduce your limit, and even demand a full payment. This is called calling the loan. Now, this doesn't happen randomly. It's usually triggered when the bank perceives a major risk. For example, if you lose your job, if your property value drops significantly, or if you go through divorce, which often forces the sale of a home. Imagine trying to sell in a down market while you are underwater on your HELOC. It can turn a difficult personal situation into a financial catastrophe. The bank isn't your friend in this scenario. It's a business protecting its investment. If they see local home values falling and your personal financial situation changing, they may act to protect themselves by cutting off your access to the very funds you were counting on as a safety net. If this is opening your eyes to the real risks, do me a favor, hit that like button. Okay, the situation can be grim, but understanding the risk is the first step of protecting yourself. A HELOC doesn't have to explode. You can diffuse it. Here is your action plan. First, get a clear picture of where you stand right now. Call a local realtor and get a current realistic market valuation of your property. Don't rely on the inflated numbers from 5 years ago. Then, add up your mortgage balance and your HELOC balance and calculate your real loan-to-value ratio. If the number is north of 80%, you are in the warning zone. If it's near 100%, you are on high alert. Stop all new spending from your HELOCs immediately. Second, make a plan to kill this debt. The single best thing you can do is to switch from an interest-only payment to a principal and interest payment. Yes, your monthly payments will go up, but you will actually be destroying the debt instead of just keep feeding it. Treat it like a debt with an end date. If you can't stomach that variable rate, talk to your lender or a mortgage broker about converting some or all of your HELOC balance into a fixed term loan. You might get a different rate, but you will gain is predictability and a peace of mind. Third, prepare for life events. The biggest amplifier of HELOC risk is job loss and divorce. You absolutely must have an emergency fund of 3 to 6 months of living expenses that is not your HELOC. That line of credit can be taken away when you need it the most. If you see uncertainty on the horizon, be proactive. Talk to a credit counselor or financial advisor before you miss a payment. Don't wait for the banks to call you. Let's be clear, the problem isn't the HELOC itself, but how it was sold and how it's being used. It was marketed as a feature of your home, like a new kitchen. In reality, it's a powerful and potentially dangerous financial tool that demands respect. For a decade, Canadians were deleveraging. But over the last few years, HELOC balances have surged significantly. This suggests many are now using their homes as ATM just to stay afloat or consolidate other debt. A recipe for disaster if not managed carefully. Your home should be a source of security for your family, not a source of risk for your bank. Don't let a financial product designed for the bank's benefit put your family's future in jeopardy. Assess your risk, make a plan, and start paying down that debt. Defuse the time bomb before the timer runs out. If this video made you think, subscribe and hit that notification bell. If you are thinking of buying or selling real estate, please give me a call. My information is in the description below. Until next time, see you soon.